All right, team, we are here back. We got Jerome Powell speaking in about 35 minutes. Put some music on as we're waiting for him to speak. We'll talk about stuff. Yeah. 12:35 p.m. Eastern Standard Time is when he's scheduled to speak. It's also in the title. There we go. Had a little bit of an echo. My bad. Yeah, gold still sitting around where it was this morning. Nasdaq broke down a little bit, but we're kind of flat. I think the market's waiting for Powell to speak here. The VIX is elevated today, showing some signs of uncertainty, and Nvidia is pretty flat in the range as it was yesterday. What's up, chat? So remember, we bought Target, and we're green on Target. I'm gonna take a little off here. I mean, I might as well, right? We're also... Okay, we're flat on Coca-Cola today. PayPal, we're green. Let's do a poll. Powell, hawkish, or dovish. Yeah, that's a good poll. I got you. Will Jerome Powell have a hawkish or dovish tone during his speech today? Hawk, dove is going to be the two options. Or actually, we'll throw neutral in there. I believe you, CT. I really do believe you, bro. You know, I believe you sat here the whole time waiting for me. Fabrice, Christoph, Fernando. Oh, timer. I got you. Timer, we got about 32 and a half minutes left. Technically, it's scheduled for... Oh, 30 hours. I did something wrong here. Hold on. Okay. This is what it's technically scheduled to start right here. We'll just leave this here. Let the timer roll. Again, markets are pretty muted ahead of all this stuff. The president did speak. Markets didn't like it necessarily. He basically said... let's find it. He said... Economy is strong, stock market is at highs, and worker wages are rising. Bostic said the Fed policy framework is valid in multiple circumstances. Bowman said inflation target range works for other central banks. And the Chinese foreign minister in a meeting with the U.S. lawmaker says China and the U.S. should enhance communications and avoid confrontation. We also had the president say he criticized NATO nations over continued reliance on Russian energy. He talks up AI as part of remarks about AI verification system for stuff. He states agreement to meet Brazilian president next week, described the conversation as positive. And markets are mostly down from this report. Powell's set to speak. So remember, at his last conference, Chair Powell said 25 basis point rate cut is a risk management decision, if you guys remember that last time. He said responding to meaningful downside risk to the labor market, but stresses he does not feel the need to move quickly on rates. He said that moving rates down slightly supports a more neutral policy stance and balances risk to employment and inflation. Music stop already, bro? I just started you. There we go. Yeah, he said that moving rates down slightly supports a more neutral policy stance and balances risk to employment and inflation. He supports for the reduction of broad. He said the support for the reduction of rates was broad, but not necessarily unanimous. And almost everyone supported the cut, showing a high degree of unity and acting cautiously to avoid labor market weakness. He emphasized meeting by meeting approach, data dependent, as he always does. He noted that markets are pricing in a path of cuts, but the Fed is focused on data rather than expectation, and that further cuts depend on the labor market developments and inflation trajectory. And with that said, we got PCE inflation on Friday that might move that needle a little bit in terms of labor, in terms of inflation risks, as well as in terms of cut outcomes. Powell said the labor market is cooling and policymakers are turning their attention to the side of the mandate. He said labor demand is softening faster than the potential supply, which could be influenced by immigration and tariffs. He said payrolls are getting weak, unemployment is low, but could rise if layoffs continue. He cited break-even rates of 0 to 50,000 payrolls. Previous estimates from the Fed had Muslim suggesting 30 to 80,000, highlighting, downside risks. On inflation, he said rises are primarily due to goods prices and tariffs, adding 0.3 to 0.4 percentage points to PCE inflation data. He said the increases are largely one-time. In the last meeting, persistent inflation risks lower than in April. Long-term inflation expectations are still stable, but they still aim to maintain 2%. He said in terms of balance sheet, which is like QT, QE, he said the Fed remains in abundant reserves and there's no big effects of the balance sheet on the economy currently. He said moderate long-term interest rates are expected from stable inflation and maximum employment, separate from dual mandate considerations though. And he also reinforced the Fed's independence. We also have some Meta news showing up in markets today. Meta announces that it is introducing message translations on its WhatsApp service. So we'll see what that means. Yeah, crypto, he didn't talk about it at all, right? He's supposed to speak again at 7:20 Eastern time tonight. And so we'll see what that means. But he's supposed to speak again 7:20 Eastern Standard Time tonight. We will see if he does and what that means. Again, Powell's scheduled to speak in about 30 minutes from now. He's supposed to speak on economic outlook. Powell is scheduled to speak at... Powell's scheduled to speak today at the Greater Providence Chamber of Commerce 2025 Economic Outlook Luncheon in Warwick, Rhode Island. Now, he's supposed to speak on economic outlook. It's titled Economic Outlook from Chair Powell. And so, he's got it. This is this is 1 week after the Fed meeting last week. So this is basically a week after last week's Fed meeting. And so we'll see what he's got to say. Let me know your predictions. Looking at our poll numbers, 38% think he'll be hawkish. We're pretty split down the middle. 32% think dovish. 31% think neutral. I'm going to go with neutral, data dependent. That's kind of what he said the last meeting. I'm going to go with that today. Nasdaq's oh wait, this is gold. I got gold up on the charts here. Let me put Nasdaq up here. Nasdaq's pretty much down on the day. Gold is choppy, but Nasdaq has reacted negatively, although it is in a range. It depends on what you think Powell's going to say today. If Powell comes out super dovish, I think markets are going to push up a little bit. If Powell comes out hawkish, it depends on how much he fears labor market turning. If he comes out as hawkish, I think markets are not going to like that, and we might see negative reactions here. And so these drops in markets could be from pricing in a hawkish Powell here, potentially. And sometimes this stuff is buy the rumor, sell the news, and so just be careful. How many times will he say dual mandate? I don't know. Most people think he's going to be hawkish. If he is hawkish, the markets might be pricing that in right now. Look at the Nasdaq break lows of the day here. Nasdaq just cracked lows at 24,927s right now in the NQ. Look at this drop right here. No, I never ended up buying Amazon. Who says nobody can make a living trading? Of course you can make a living trading. How do you think hedge fund guys earn a living? Like, of course you can make money, but in order to do so, you need a lot of money, right? In order to live purely off of trading, you need millions, probably. Depends on what you can live off of. If you can live off of 20K a year, sure, you could live off of trading, but it depends on where you live as well. But if you want to make 100, 2, 3, 4, 500,000, you need millions to do it. You're not going to be able to make 100% every year. Most of the people aren't, at least. Very, very small percentage of people. Of course, everybody on the internet's geniuses, and you know, they make $1 billion every year. But for real life, it's really not like that. The problem is that they push out these wild expectations of percentages. Yeah, I mean, some people can't. Look, it's a small percentage, though. It's a small percentage. Some people can genuinely make a living. It's a small percentage. Yeah, prop firms in that regard are useful because it'll get you around it. You know, you get to keep 90% anyway, so it's similar to funding your own account, just less risk. Top Step, check them out. But yeah, very useful. All right, guys. All right, we're down to 920s here, still breaking down. The VIX is elevated, Nvidia is down, gold is flat, Nasdaq's flushing here ahead of Powell. And again, Powell is supposed to speak on economics. So we got 25 minutes left. He's supposed to speak on economics. Let's see what it looks like. Nasdaq flushing. Again, last week, Jerome Powell cut rates 25 basis points. Yeah. Okay, so here's...
And Congressman Seth Magaziner, and as well, Federal Reserve Bank of Boston President and CEO Susan Collins for being with us today. Thank you very much.
I'm going to start it now.
I would also like to acknowledge the presence of our many general officers who are here today, state general officers, as well as leaders of our legislative delegation who have joined us as well. At this point, a couple of words of recognition and thanks to special members of the Greater Providence Chamber of Commerce.
Yeah, so look, Powell's not scheduled to speak for another 20 minutes or so. So give him some time. He's not scheduled to speak for another 20 minutes or so. We're watching this now. I'll let you know when Powell starts to speak, because they're basically just going to thank a bunch of people here.
The sponsor is the University of Rhode Island. And I'd also like to recognize, yes, we will hear from President Pallange in just a minute.
And so when Powell starts to speak, I'll let you guys know, but he ain't speaking yet. Not yet. With that said, though, if you take a look, we'll put some other stuff up here. And I'll stretch it out a little bit for you guys. Nice. This out. Put like parts up down here. Got Nvidia up there. We got like gold. These out too. Put some closed captioning up here, but I don't see. But yeah, so. Is there a buying opportunity for Lucid, bro? I haven't heard the name Lucid stock in a minute. I don't know who this guy is speaking, but Powell isn't scheduled to speak yet. I'm watching this, though. The point is, we're watching it. We're waiting here. Powell to get on board with this. He's supposed to speak, and again, scheduled for 12:35 market time, which is in about 20 minutes or so. About 20 minutes. It's scheduled basically everywhere. And again, in case they start early, which I don't think they will, we'll have it here live. Okay? So in case they start early, which again, I don't think they will, we'll have it here live. Powell's supposed to speak at 12:35 p.m. This guy speaking right now.
Research and faculty positions at Monash University, one of Australia's premier research universities.
It's not Powell. I don't know who this is, but it's not Powell. I'm waiting for Powell. And yeah, we're here. We're waiting. Yeah, VIX is elevated right now. It's at 1630s. If the market keeps breaking down, the VIX will probably continue pushing here. So we're waiting. I don't know about buying Nvidia. I like Nvidia long term. It would have to be a long term investment, not a swing trade. My target trade, remember I added to my target position yesterday. We're now very nicely green. Our average price is 86 cents or $86. It's at $87, $88 now, so we made a couple percent there. I will take it. That's good. I'll put the music on as we wait here. Still waiting. I can put this up while we're waiting too. But Powell's not speaking yet. We're waiting for Powell to speak. Hey, hit the like. Do me a favor. Hit the like button. Hit the subscribe button. Thanks so much. I appreciate all the love. Again, Powell speaks at 12:35 p.m. Eastern Standard Time. So in that regard, we got a little bit less than 20 minutes. Canadians. These guys going to the store, eh? I lived in Canada for years. Nice people. Just nice people. Good food. Nice people. Cold weather, though. Yeah. Netflix down a little bit. Nasdaq's down. I don't think it liked what the president said this morning. So Nasdaq is down. We're waiting for Powell. Powell said to speak at 12:35. Wait, is this Powell? Okay, no, that's not Powell. Okay, sorry. I thought it was Powell at first. I wanted to make sure we weren't going to miss Powell. Instead, it's some other guy. What color will Powell's tie be today? That's the big question. I'm going to go with a light purple. Last time it was a dark purple. I'm going to go with a light purple this time. Powell likes to switch it up. You know, will he wear a tie today is the question. I don't know. Talked about it earlier. Last time it was a darker purple. And today I'm going to expect it to be, you know, light purple. Just because, you know, balance. All right, guys. Got about 1,000 here. Still got 20 minutes. 15 minutes. All right, Nasdaq's bouncing back up a little bit. Yeah, I don't know what this guy's saying, but it's not Powell. Powell's got to speak in 18 minutes, 17 minutes. I'm not saying bye. What's Powell speaking on? He's supposed to speak on economic outlook. It's actually titled Economic Outlook for today. So he's supposed to speak on economic outlook. We'll see what he does. Let me make myself a little bit smaller here. There we go. I can't even write this out. This is the top 3 greatest writing ever. You're welcome. Okay, just as I know everybody's gonna ask me what time. Powell, 12:35 Eastern time. Are we bullish or bearish? I don't know. We got the poll. Poll mostly thinks that Powell's going to be hawkish during the speech, which means he's going to be restrictive. He's going to fear inflation. He's going to be not so pushing of interest rate cuts during the speech. Now, again, we'll see what it says. Again, the Federal Reserve, their job is to maintain balance, so they have what's called a dual mandate. They want like a strong labor market and economy and low inflation, But again, as I always say, it's kind of like having your cake and eat it too. You know, that's like saying I want to earn, $1 million a year and not pay any tax on it. Of course I do, but is that feasible? Maybe. If we have inflation fears, the Fed is less likely to cut interest rates because stimulating the economy by lowering rates might make inflation worse. People tend to spend more, businesses, all that stuff. And vice versa. If we have really weak labor market where we're trending towards a recession, the Fed might actually do the opposite and cut interest rates. If they do a desperate thing called, then you can kind of look at their balance sheet, right? They can also control things a little bit with their balance sheet. It's usually a more desperate move, like reducing their balance sheet is called tightening, quantitative tightening. They don't directly sell it. They don't directly sell the bonds and MBSs in their balance sheet. They just kind of let them mature and run off, and they unload the balance sheet that way. But they came out last week and said that their balance sheet still had abundant reserves. They'll do that if inflation's like a really bad thing. It's a restrictive monetary policy. Easing, quantitative easing, is money printing. They create online bank reserves, and then they use that to buy up bonds and other financial assets. This injects liquidity into the markets and ultimately helps bring interest rates down a little bit faster. But it's a more desperate thing, and that can cause inflation more than a lot of things. So their job is to maintain balance. Right now, we're still tightening. So the Fed's still slowly unloading their balance sheet. They reduced it by 80% a couple meetings ago, but they kept MBS, which is mortgage MBSs. They kept that reduction the same speed, so they didn't slow the reduction of MBSs. But anyways, right now the Fed cut 25 basis points last meeting, and that's a 0.25 percentage point. It's not the biggest cut, but they think we're going to do 25, 25, 25. At least that's what a lot of analysts expect, and that's kind of what I expect too, as long as we don't see some big changes. And we got one more meeting in October, one more meeting in December, and so we'll have probably 3 cuts by the end of the year unless something changes. And something could certainly change, right? Some of the things that could change is PCE inflation on Friday shows elevation. If it's high inflation on Friday, that might push back the odds of rate cuts. If we get low inflation on Friday, that might push up the odds of stronger cuts or, reinforced 3-cut premise this year. And yeah, that's essentially where we are at now. That's essentially where we're at now, is expectations are for 3 cuts this year. If you take a look at the CME watch tool, you can also watch yields. Yields and interest rates follow each other. And so you can watch yields. Interest rates in that context follow each other. And so we can take a look at like 10-year treasuries. I believe 10-year treasuries are still around where they were this morning, which is 1.25%. Yeah, they haven't really changed. So if you take a look at 10-year yields right now, they're at 4.125%. So they were after the last Fed meeting, they were down to like 4%. They've since risen since then with, I guess a lot of people interpreted it as a little more hawkish than expected. If you look at the Fed watch tool, it's basically unchanged for October. This will tighten up and start moving a little bit closer the closer we get to the next Fed meeting. But right now, it's 8% chance of a pause, so no cut. We got an 8% chance of no cut in October, and we have 92% chance of another 25 basis point cut in October. That's what we're looking at right now for Fed. Powell's still not live yet. He's supposed to speak in about 10-12 minutes or so. We'll see what it looks like. See what they got to say still. And they put us on hold. And again, vote on the poll. Let me know what you guys think. Google? Yeah. The speech isn't on right now, bro. Look, it's paused. Wait, this isn't it, is it? No, they couldn't make this it. I think they're going to come back. Yeah, it's live right now. Okay, yeah, it's live right now. Okay, we are live. Yeah, look, it's ticking by. It's still live. Okay, it's at 59 minutes now. It's still ticking. Time's still ticking. We're waiting here, guys. We're waiting. But they're paused right now. Did I buy gold? I don't know. I mean, a lot of people are arguing stagflation. So what are the economic states that can precede a recession? I say can because it doesn't always. But one of the economic states that can precede a recession is something called stagflation, which is a period of economics in which we have the worst of both. We have high inflation, which is bad, and we have a weak labor market, which is bad, right? And to fix either of those things, you have to kind of ignite the other one. so to speak, right? So it's kind of a difficult state of economics and markets. And it can sometimes precede a recession. And a lot of people would argue we have that right now. We're showing signs of a weak labor market. We're showing signs of elevated inflation. And a lot of people were worried. A lot of people are also worried if rates start to get cut. They think if rates start to go down, a lot of people are sitting on low interest rates that they bought a long time ago in homes, right? Say you bought a home at 2.5%, 3% interest, right? And then rates went up, but you wanted to sell your house. You want to sell your house, but rates are 6-7%. You're going to pay 3 times that in interest if you mortgage another property and sell your current one, right? And get out of that low interest rate. And so a lot of people are waiting for interest rates to come down to sell because they're stuck in a low interest rate in a home they don't even want to live anymore, but they don't want to mortgage another one at 6 or 7% right now. And so a lot of people are speculating that once rates go down enough, people are going to start unloading homes. That might make a big dip in home prices, or it could cause home prices to go up. But some people think we're going to get a big correction in home prices because of that, because there's so many houses that are waiting to be put on the market, and there's going to be too many homes and not enough buyers, so to speak, right? But yeah, we'll see. Let me know if you agree with that. Yeah. Crypto, yeah, Bitcoin struggling today. Down to, I mean, Bitcoin's, it's at 112, it's almost 113 still. So it actually rebounded a little bit today. All right, guys. Again, we are trending towards this. We have about 7.5 minutes, 8 minutes left. Many that bought the last few years and overpaid will be in trouble. Yeah, I mean, it depends, right? Like, I think naturally home prices are going to go up most of the time. You know, home prices dip, but they don't stay down usually. So generally speaking, home prices, as long as you buy in a good neighborhood, they're going to increase over time. Thing is, economy is bad, stocks, gold, crypto are at their tops. This looks like a massive bubble. Yeah, a lot of people think we're in a bubble like 2000. I don't know. 2000 was sparked by wild speculation in the internet. The internet took off. A lot of companies IPO'd pre-profits and failed once the dot-com bubble burst, and then that drove markets down and ended up crashing down. The question is, are AI stocks overvalued? And the internet was that next big thing, but a lot of companies just didn't make enough money, and the root of the problem was that they were IPOing pre-prices. Like, I've told the Netscape story before about how Netscape, prior to Netscape, the standard was you needed a certain amount of profits to IPO. Netscape did it pre-profits and made billions of dollars doing it. But it was a bubble. They competed with Microsoft. Microsoft offered Internet Explorer for free, and Netscape was a browser company that sold browsers. So when Microsoft started offering Internet Explorer on their operating systems for free, Netscape eventually went from billions to only a couple million and failed. And so it's an interesting internet story. But the question is are AI stocks overvalued? And I'm sure there's some of them that certainly are. But will AI grow into it fast enough to avoid a bubble bursting is the question. And I don't know. Again, y'all hit the live button next to the play button, put it in 2x speed. Powell is set to speak live very soon. Yeah. So again, hit the subscribe button, hit the notification bell. Powell set to speak live very soon. Yeah, he's going to be speaking at the Greater Providence Chamber of Commerce 2025 in Warwick, Rhode Island. Again, we're here waiting. Starts in about 5 minutes. No, I agree. There's a lot of doom and gloom. I mean, crypto's moving up a little bit. Crypto's flat on the day, slightly green. All right, guys. So, yeah, we got less than 5 minutes now. Again, make sure you hit the live button next to the play button. Make sure you fully catch up to the stream. We appreciate it. Yeah, a lot of PE ratios in AI are overvalued. Usually a good PE ratio is under 20. Now you see them 50, 60, you know, you see much higher than that as well. All right, guys, we got 1,600 people here. Still got about 4 minutes left. We're waiting for them to start. You can see we're completely live on this stream right now. I might zoom in a little bit too, make it a little bit cleaner. Do it. Move this over a little bit, make it a little bit larger for you guys. Make this a little bit smaller. Huh? There we go. Okay.
And we will begin the program in earnest. It is now my honor to introduce someone who, candidly, I was told, simply say, "It's just Jack," and then leave the stage. However, I would not want to be disrespectful in that regard. I have the honor of introducing our senior United States Senator, Jack Reed, who will in turn introduce Chairman Powell. Jack Reed is a champion for middle-class families and a strong believer that all Americans should be able to have the opportunity to build a better life. He was born and raised in Cranston, grew up on Pontiac Avenue, just a short drive from here. And his parents instilled in him the importance of serving his country and giving back to his community. He graduated from LaSalle Academy. I suspect there might be a few LaSalle grads in this room. And was nominated for an appointment to the United States Military Academy by, I would say, a fellow legendary U.S. Senator, John Pastore. After graduating from West Point near the top of his class, unlike his dear friend, the late John McCain, who did not quite graduate in the top of his class at the Naval Academy, he received an active duty commission in the Army, earned a master's degree in public policy from Harvard's John F. Kennedy School of Government, and a law degree from Harvard Law School. One of the highest honors and greatest privileges of his life was commanding his fellow soldiers. He served in the 82nd Airborne Division and eventually joined the faculty at West Point, where he served until August of 1979, resigning from active duty as a captain, but continued to serve in the reserves, where he left with the rank of major in 1991. After graduating law school, the senator was an attorney in private practice back in Providence. He served 3 terms in the Rhode Island State Senate and 3 terms in the United States House. And in 1996, the people of Rhode Island elected him to succeed Claiborne Pell as the state's 46th United States Senator. He has worked every day since to help make the federal government more efficient, effective, and responsive to the people of Rhode Island. He has a proven record of working on a bipartisan basis to help solve problems and achieve results. Many of us in this room also had the opportunity to go to his Business Leaders Day in Washington recently, and we saw firsthand the respect of his peers from both sides of the aisle. He is the senior member of the powerful Appropriations Committee, which controls the funding of the United States government, and has worked tirelessly to direct federal funding to the Ocean State. He is one of just 8 United States senators in the history of the United States Senate to graduate from West Point, and has used that knowledge as the ranking member of the Armed Services Committee, where he's played a pivotal role in safeguarding our nation and growing Rhode Island's defense sector. And as senior member of the Banking, Housing, and Urban Affairs Committee, he has authored several key pieces of legislation, including historic Wall Street reforms. He has been a nationally recognized leader for his dedication to protecting U.S. consumers. Today, Senator Reed continues to use the lessons he learned growing up in Cranston, which were deepened in the Army and have been tested in the halls of Congress. and stands up and speaks out for hardworking families who are the heart and soul of this country. He is dedicated to the nation's security and ongoing prosperity. Senator, we are grateful for your support for this event, for the work of the Greater Providence Chamber of Commerce, your advocacy for our members and their businesses, and for being a champion for our state, and putting into practice each and every day the values that you learned at that kitchen table on Pontiac Ave in Cranston. Senator Jack Reed.
What an introduction. This is the guy introducing the guy who introduces the other guy.
Well, thank you very much, Rick, for that extraordinarily kind introduction. I also want to thank Lori White for her great leadership and all the members of the Greater Providence Chamber of Commerce. To all my colleagues in government, thank you for joining us here today. I want to particularly shout out to Susan Collins, the president of the Federal Reserve Bank of Boston, an extraordinary public servant, and President Mark Palange of the University of Rhode Island. He has really taken a great university and made it even greater. Thank you, Mark. Today, I have a distinct honor. That is to welcome Jerome Powell, the chair of the Federal Reserve, back to Rhode Island. Along with many of my colleagues on both sides of the aisle, I have long appreciated Chairman Powell's decency and steady leadership and commitment to the values that distinguish America from every other country in the world. He has the distinction of having been appointed by a Republican president and reappointed by a Democratic president. He has shown the courage to make tough decisions in an exceptionally challenging economic and political environment. And he has made these decisions based on the data and the facts and good analysis. And that is something increasingly rare these days. It feels like a much different world today than the last time Chair Powell addressed us in 2019. The COVID-19 pandemic brought substantial economic upheaval, including unemployment rates we had not seen for decades. That crisis was followed by a serious bout of inflation. And in fact, every economist, left and right, were predicting not about the coming recession, but how severe it would be. Because of Jerome Powell, there was no recession. Chair Powell deserves credit for navigating those choppy waters. Nevertheless, average Americans are still facing significant economic challenges due to the chaotic policy agenda of the current administration. Tariffs, health care cuts, a massive debt increase, and interventions in the operations of major corporations and universities have all proved disruptive and costly. Real wages for most American workers remain stagnant. We still have not fully tamed inflation. Roughly 36 million Americans are experiencing poverty, and housing is too expensive and in too short a supply everywhere, but particularly here. The policy chaos is extended into a direct assault on the Fed's independence and personal attacks by the president against members of the Fed. But Chair Powell has met these challenges with equanimity and professionalism. He understands that a strong and independent central bank can contribute to sound economic policy in this nation. He understands the impact that monetary policy has on communities and families and businesses. He has somehow managed to stay laser focused on achieving the Fed's dual mandate to achieve maximum employment and stable prices. Chair Powell, thank you for doing your job with honesty, integrity, and humility. I speak for all of us here. There are few examples of patriotic, decent dedication to the nation than Jerome Powell. And thank you for returning to the Providence Chamber during your final few months as Fed Chair. You are more than welcome. Ladies and gentlemen, would you please join me in welcoming Chair of the Federal Reserve, Jay Powell.
Thank you for your warm reception, and thank you, Senator Reid, for your very kind introduction. It is a pleasure to be back in Rhode Island. The last time I had the opportunity to speak to the Greater Providence Chamber of Commerce, as Lori mentioned, was in the fall of 2019, actually November 25th, 2019, and I said then, quoting, "If the outlook changes materially, policy will change as well." Well, little did any of us know, just a couple of months later, the COVID-19 pandemic arrived. Both the economy and our policy evolved dramatically in ways that no one could have predicted. Along with actions by Congress, the administration, and the private sector, the Fed's aggressive response helped stave off historically severe downside risks to the economy. The COVID pandemic came on the heels of the painfully slow, decade-long recovery from the global financial crisis. And these two back-to-back world historical crises have left behind scars that will be with us for a long time. In democracies around the world, public trust in economic and political institutions has been challenged. Those of us who are in public service at this time need to focus tightly on carrying out our critical missions to the best of our ability in the midst of stormy seas and powerful crosswinds. Throughout this turbulent period, central banks like the Fed have had to develop innovative new policies that were designed to deliver on our statutory goals during times of crisis, rather than for everyday use. Despite these two unique, extremely large shocks, the U.S. economy has performed as well or better than other large advanced economies around the world. And as always, it's essential that we continue to look back and learn the right lessons from these difficult years, and that process has been ongoing now for more than a decade. So, turning to the present day, the U.S. economy is showing resilience in the midst of substantial changes in trade and immigration policies, as well as in fiscal, regulatory, and geopolitical arenas. These policies are still emerging, and their longer-term implications will take some time to be seen. Recent data show that the pace of economic growth has moderated. The unemployment rate is low but has edged up. Job gains have slowed, and the downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In recent months, it has become clear that the balance of risks has shifted, prompting us to move our policy stance closer to neutral at our FOMC meeting last week. GDP rose at a pace of about 1.5% in the first half of this year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. Activity in the housing sector remains weak, but business investment in equipment and intangibles has picked up from last year's pace, largely reflecting the AI build-out. As noted in the September Beige Book, which I bet you wonder what it is. The September Beige Book, that's a report that gathers qualitative information from across the Federal Reserve System. We'll talk about later. Businesses continue to say that uncertainty is weighing on their outlook. Measures of consumer and business sentiment declined sharply in the spring. They have since moved up, but remain low relative to the start of the year. In the labor market, there has been a marked slowdown in both the supply of and the demand for workers, an unusual and challenging development. In this less dynamic and somewhat softer labor market, the downside risks to employment have risen. The unemployment rate edged up to 4.3% in August, but has remained relatively stable at a low level over the past year. Payroll job gains slowed sharply over summer months as employers added an average of just 29,000 per month over the past 3 months. The recent pace of job creation appears to be running below what we call the break-even rate, that is the rate needed to hold the unemployment rate constant. But a number of other labor market indicators remain broadly stable. For example, the ratio of job openings to unemployment remains near 1, and multiple measures of job openings have been moving roughly sideways, not down, as have initial claims for unemployment insurance. Inflation, meanwhile, has eased significantly from its highs of 2022, but remains somewhat elevated relative to our 2% longer-run goal. The latest available data indicate that total PCE prices rose, that's personal consumption expenditure prices, that's the inflation measure that we follow most closely, rose 2.7% over the 12 months ending in August, up from 2.3% in August 2024. Excluding the volatile food and energy categories, core PCE prices rose 2.9% last month, also higher than a year ago. Goods prices, after falling last year, are driving the pickup inflation. Incoming data and surveys suggest that those price increases largely reflect higher tariffs rather than broader price pressures. Disinflation for services continues, including for housing services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs. Beyond the next year or so, however, most measures of longer-term inflation expectations remain consistent with our 2% inflation goal. The overall economic effects of the significant changes in trade, immigration, fiscal, and regulatory policy remain to be seen. A reasonable base case is that the tariff-related effects on inflation will be relatively short-lived, a one-time shift in the price level. Now, a one-time increase does not mean all at once. Tariff increases will likely take some time to work their way through supply chains. As a result, this one-time increase in the price level will likely be spread over several quarters and show up as somewhat higher inflation during that period. But uncertainty around the path of inflation remains high. We will carefully assess and manage the risk of higher and more persistent inflation. We'll make sure that this one-time increase in prices does not become an ongoing inflation problem. Turning to monetary policy, near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path. If we ease too aggressively, we could leave the inflation job unfinished and need to reverse course later to fully restore 2% inflation. If we maintain restrictive policy too long, the labor market could soften unnecessarily. When our goals are in tension like this, our framework has long called for us to balance both sides of our dual mandate. The increased downside risks to employment have shifted the balance of risks to achieving our goals. We therefore judged it appropriate at our last meeting to take another step toward a more neutral policy stance, lowering the target range for the federal funds rate by 25 basis points to 4 to 4.25%. This policy stance, which I personally see as still modestly restrictive, leaves us well positioned to respond to potential economic developments. Our policy is not on a preset course. We will continue to determine the appropriate stance based on the incoming data, the evolving outlook, and the balance of risks. We remain committed to supporting maximum employment and bringing inflation sustainably to our 2% goal. Our success in delivering on these goals matters to all Americans, and we understand that our actions affect communities, families, and businesses across the country. So thank you again for having me here, and I very much look forward to our discussion. Thanks.
Thank you very much. Good afternoon once again, Mr. Chair. Thank you for those opening remarks and reminding us just how tremendously the world has changed and evolved since you were last here in 2019. President of the Federal Reserve Bank of Boston, Susan Collins, is also here with us today. And President Collins, we have had the opportunity many times to discuss with you the conditions in this Fed region, of which Rhode Island is part of the Boston region. So, Mr. Chairman, I would ask you to think about your comments reflecting on the importance, what you have said, the importance of deeply understanding local labor markets. And I'm wondering if in your deliberations leading up to the most recent FOMC meeting, whether there was anything particularly distinctive in what you saw coming out of the Boston Beige Book.
So let me say a word about the Beige Book. So there are 12 reserve banks, as you know, around the country,
And each of them has deep ties into not just the business community, but medical community, educational community, nonprofits. And each FOMC cycle, which is sort of 8 of those a year, they do a deep dive and they collect lots and lots of information about the economy. And so, and that information gets collated and put into what we call the beige book, because it's beige. And we're not that original. And so we get that a couple weeks before each FOMC meeting. And I have to say, I don't know of any source of sort of qualitative information about the economy that even approaches this. It's just a lot of conversations with a lot of people, and I personally find it very useful. Sometimes you look at that book and you see significant regional differences, and this is not one of those times. So, for example, the Boston Fed piece in the last beige book talked about lots of spending on AI. Well, guess what? That was pretty common across 8 or 9 of the districts. So I would say nothing really jumped out from the Boston piece. What you saw was all around the country, you saw pretty modest growth, wage and price inflation at modest to moderate levels, the economy growing but not fast, and uncertainty, significant uncertainty about federal public policy is kind of weighing on investments and decisions about investment and hiring, except in the area of the AI build-out, which is just going really strong pretty much many parts of the country.
So nothing distinctive from the Boston region that would inform your future decision-making, looking at the setting of monetary policy?
What I saw from Boston was quite similar and overlapping with a number of other districts. Again, sometimes that's the case where things are pretty much of a piece. Sometimes different regions, particularly if there's a commodity price thing, you would see maybe things in the commodity-oriented regions doing differently from other regions of the country. Right now, it's it's much more the same around the country, I would say.
So let's talk about and build on what you described a few moments ago about the dual mandate of the Fed. And if you could talk about these conditions that wax and wane over time, what signals will you be looking for in the run-up to the next FOMC meeting, which is in roughly 30 days?
We have 2 goals, as you mentioned, maximum employment and price stability, and they're equal goals under the law. So almost all the time, they work together. They complement one another. So, for example, when the economy is weak, the unemployment rate might be high and the inflation rate would be low, and that it calls for stimulus from us. And when the economy is really strong and the labor market is tight, that's when inflation will be moving up, and so policy might be a little bit tighter. That's almost always the case. Right now is the quite unusual case where risks to, as I mentioned in my remarks, risks to employment are to the downside and to inflation to the upside. Now, we only have one tool, which is monetary policy, really interest rates, and really it's calling for different answers. So for a long time, we have a document called the Statement on Longer Run Goals and Monetary Policy Strategy. We call it the consensus statement to save time. That says, for a long time, it's said that when the 2 goals are in tension, we'll look at how far each one is from its goal and the time that it's expected to take to get back to that goal. And so we balance the 2 goals. So what we've done all year this year is we've had our policy rate has been tight because inflation has been above our target, but the labor market was very solid. Now, over the last really 4 months, really over the summer, the labor market has softened. Payroll jobs have dropped a lot, so we can't really say that anymore. And I think what that told us is that stance of really having a tight focus on inflation really needs to moderate toward a more balanced approach. And so that's why we took the action we took at our last meeting. And as we go to our next meeting, to your question, we'll be asking ourselves, we'll be looking at the data very carefully, labor market data, growth data, inflation data, all of the vast quantities of data that we get, and asking ourselves, is our policy in the right place? And if not, we move it there.
Some may wonder about the frothiness of the markets, the markets reaching record heights and also record valuations. How does the Fed think about that in the equation?
Financial markets? So we monitor financial markets very carefully. Our policy works through financial conditions. So that's credit spreads and interest rate levels and
equity prices in the aggregate that can affect spending, for example. We look at all of that, but really our focus is on our two goals, and that is maximum employment and price stability. And when we see one of them weakening, we're going to respond appropriately with our tools. And in this case, that meant reducing the federal funds rate by 25 basis points, and we'll see what the future brings, but that's what we do. We look carefully at financial conditions, more from a perspective, though, of financial stability. So we see that the banks are well capitalized. Actually, in the aggregate, households are in good shape financially. I know people at the bottom end of the income spectrum are under pressure, no question about that, but it's not a time of elevated financial stability risks.
Mm-hmm. So the federal funds rate really governs consumer credit, but not so as it pertains to mortgage rates, correct?
That's right.
And let's talk about how the average consumer is going to see any difference in the intervening months relative to an easing of interest rates and the ability and maybe even more confidence to spend.
So we don't set mortgage rates, but when we change the federal funds rate, it will affect the mortgage rates and also all other consumer borrowing rates. Really, all interest rates that are on a floating basis will move a little bit or even a lot if they're short term, based on our moves. So the people will feel that over time. Also, it's not just these days. The market is pricing in the next 6 months what's going to happen to rates. So this is something that wasn't really the case 50 years ago. Now markets listen to us and follow, and they make an estimation of where they think rates are going, and so they'll price things in. And so longer term rates will move because of what the market expects, market participants expect us to do. So you'll begin to see, and you're already seeing changes in rates long before we make the decision. It can often be already priced in.
Is it fair to say that the Fed and the markets really have a higher tolerance for risk today, more so than perhaps before the pandemic?
I think if you look at some prices, then they're elevated relative to historical levels. There were times before the pandemic when it happens periodically. Equity prices will move up and down, and we do monitor that. But we're not targeting any level of prices for particular financial assets. We don't have a view that we know what the right price of any particular financial asset is. We do look at overall financial conditions, and we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve. But you're right. It by many measures, for example, equity prices are fairly highly valued.
Let's segue to the topic of AI, and largely AI stocks and periphery stocks really driving the markets in many ways. Let's talk a little bit about the great unknown of AI, and if we think about various ages, our industrial ages, whether it be steam to electricity to the information age and now to the age of AI, would you consider this to be the most disruptive force ever in modern American history?
I think it's way too early to say that. I wouldn't go that far. I would say clearly generative AI has all the earmarks of an emerging technology that could be very important in our economy and in our society. But it's very early to be making that kind of bold statement. So, what we're seeing is companies and institutions like the Fed for that matter, are starting to experiment with how this new set of tools can be used in our operations. Mm-hmm. And it's very early days on that. And I think we have to wait and see. That's a good thing. I know many of the large financial institutions and other central banks, and we are asking ourselves, how can this help us do our jobs better? And I think it's going to be a period of experimentation over a period of years. And the history is always that there's a lot of fear that technological innovation will eliminate jobs. What has tended to happen in history over time is that it just raises productivity and creates new jobs to replace the old jobs. And that happens. And sometimes it can take a long time, but ultimately that has been the pattern for the last couple of hundred years. Is this time going to be different? I just don't think we know yet. I don't think anybody knows.
Mm-hmm. You are a labor market futurist, also a historian, and the concept of AI and humans in the loop, very profound impact on the labor force. What are your thoughts about specifically agentic AI as a differentiator from generative AI, and how will the Fed be looking at the impacts of the workforce, the labor participation rate, given the unknown of what could happen with displacement around AI tools at all ends of the spectrum?
You know, our tools work on demand, basically. Lower interest rates, higher interest rates, they work on demand. When there are structural changes in the economy, there's not a lot that an interest rate change can do for that. And so if you're talking about distributional issues or labor force participation or retraining or any of the things that come to mind in connection with those questions, that's really going to be something for legislators and the private sector. We of course, we have many labor economists, and a good portion of them are studying what the potential effects of AI on the labor force, and many great economists around the country and around the world are publishing on that now. And you know, it really is too early to say. I think you can say that some jobs are going to be phased out, some jobs are going to evolve, and people are going to be further trained and that sort of thing, and be able to keep a job like that. And there'll be new jobs that come. And how will that balance work out, and what will be the timing of it? I think it's just quite hard to say.
But how does that factor into the deliberations on a near-term basis? Things are moving so quickly, and the observation and the argument that artificial intelligence isn't just impacting those entry-level jobs and those, quasi-unskilled jobs, but really tentacles reaching into highly skilled professions, whether it be finance, whether it be communications and media, whether it be healthcare, whether it be law, finance. So all ends of the spectrum, highly educated individuals down to more easily automated tasks. Sort of a really interesting problem for those of you that are studying labor market economics. How do you approach that?
Well, a lot of what we're doing with our time is trying to understand the current position of the economy, what's actually going on in the economy today. Pardon me. So part of that is hiring rate has really dropped. Job creation has dropped very sharply. So what are the factors there? So I mentioned earlier, I think, part of it just is there's a lot of uncertainty about the direction of public policy, and so companies are holding off, they're not hiring, and when you don't hire through attrition, your labor force shrinks and you save money that way. That may be a way of passing on tariff costs. It may be something like that. So that's happening. Lots of questions around whether AI is a major factor associated with the relatively low hiring rate for people just graduating from school and just entering the labor market. And people are doing studies on that, and I looked at one from Stanford, another from the New York Fed in the last week, and the sense of it was, we think we can find some evidence that generative AI is having some, it's one of the reasons here, but we can't really say it's the main reason. And we have our Jackson Hole conference every year in Jackson Hole, Wyoming, and we had some great labor economists, and one of the big debates was what's going on with AI, and there was a professor from, I want to say, Columbia, who just basically said there's no evidence that this is acting any differently than her view was not acting any differently from other technological movements, waves. And so I think she would be more at the end of an optimist, a techno-optimist. Mm-hmm. We've all, there are books out there that will tell you the world is ending, and but I don't think we know. Again, I think we're going to see how this evolves, and again, if it does turn out to be something where labor force participation really declines in a way that creates social difficulties, that's going to be something that legislators and the private sector will have to address. We just don't know that yet, though.
Over the weekend, I read where you had been discussing, just picking up on what you said about Gen Z and college graduates and any possible disruptions in trying to find jobs. So Gen Z would be those born between 1997 and 2012, roughly ages 13 to 28. What are your thoughts on college enrollment? We'll talk a little bit about labor disruption in just a minute, and Jackson Hole, because I know that's a favorite of yours. But a lot of the individuals in this room today may have family members that fall squarely in that 13 to 28 category. What would you say about that?
I mean, again, we all see the data that it's just gotten tough for people just entering the labor force to be hired. But remember, the overall national aggregate hiring rate is at very, very low level. The layoff rate is also at a very, very low. You're in a low fire, low hire economy. And it feels like companies are they've kind of stopped hiring or slowed down their hiring because they want to see how this all shakes out. We're having very important changes to economic policy in the United States, and companies and people are wondering, how's that going to work out? So I think that's part of it. The other thing I would add, though, is, there's a lot of good scholarship around technological innovation and inequality, if you will. And the sense of it is really that if schools and society give students graduating the skills and aptitudes they need to benefit from evolving technology, you can have declining inequality over time. And that's what the United States had for many, many years, up until about 1970, when U.S. educational attainment kind of plateaued and inequality takes off. So it's really down to having the skills. So kids who come out of school today with technological skills and can work with this new technology, they're probably going to be fine. They're going to be great. If you don't have those skills, though, you're increasingly left with less attractive employment options. So in a way, it's an educational issue.
Our society is our education system, and you spoke about inequality, particularly the digital divide, and thinking about where the United States really has paced among countries throughout the world. Particularly, that was a subject that you initiated at Jackson Hole back in August. What are your thoughts on how that is likely to really change the way we look at technology as a force for productivity and advancement?
I mean, technology has been raising incomes and productivity for really a couple hundred years since the Industrial Revolution. It's been an amazing thing for the quality of human life, and there's no reason why that has to change. In the United States was the first country to have gender-blind secondary education, and if you go back, you'll see that there's a great book on this, but it just basically the U.S. had fast technological innovation for a century, and also declining inequality because people were coming out and their educational the capabilities they took out of the educational system gave them the ability to benefit from evolving technology. So, and that's really the key, because technology, what it does is it makes us more productive. One summer I worked on a project that was building houses, and I basically had a shovel and I just dug most of the summer. And now that would be a Bobcat, which can do 100 times the work, no blisters, no water breaks. It's just much more productive. And you see housing production's gotten, at least it did get for a while, much more productive, not so much lately. But that I think is the story. And while U.S. educational attainment, college graduation rates and things like that leveled out, they're still going up. The rest of the world caught on and has really caught up in terms of educational attainment. And that really is the key. To your point, your educational system, your country is your educational system ultimately. It's the people that come out and what can they do, and a variety of other factors too, obviously. But I think that's a key element. I'm struck by this because this was a major factor at our recent conference, and we had a great conversation about it.
Well, tell us about the book. He gave me a homework assignment the other day, so I did download it, but I think everyone should follow that lead.
All right. It's a book's called The Race Between Education and Technology. It's by Claudia Golden and Larry Katz, two Harvard economists, and it basically talks about the race between education and technology. So I'd recommend that to anybody. It was written in, I want to say, 2005, and they basically presented at Jackson Hole, they presented an update to the current day. The findings basically hold. It's very, I mean, I'm not a PhD economist. I read it 20 years ago.
But you said it still holds very much true today.
It does. And I think it's a good explanation for why the U.S. has had, rising inequality. This is their thesis, and I think it's they call it also skill-biased technical change. So you need skills to benefit, but if you have those skills, then technology makes you more productive, and that's what we need. Incomes can only rise if productivity is increasing. We're sort of working as many hours as we can work now, so it really is down to how much output can you have in an hour, and that's productivity. So I would recommend that. I'm not getting any royalties for that, but by the way, Claudia Golden won the Nobel Prize for her work about 2 years ago. So I'm not the only one who thinks it was good work.
Chair Powell, let's move on to tariffs. This is an issue that confronts the business people here with us today. You addressed it very briefly in your opening remarks. You indicated that you believe that the costs of the tariff movement is in fact more transitory than embedded in supply chain. So I think we would appreciate hearing more about how the Fed thinks about evolving tariff policy.
So we're now collecting a good bit of revenue. The federal government collecting a good chunk of revenue, at a $300 or $400 billion a year pace. And the question is, who's paying that? And the candidates for paying those tariffs would be the exporter, the foreign exporter, or someone on our shores. It could be a company or a retailer, or someone who's using the imported product to manufacture something, or the end consumer. And so so far, in its incredibly early days, it doesn't look like the overseas exporters are carrying the bulk of it. It looks like it's that middle group. It's retailers and it's importers, and they're not passing along to consumers that much of the cost. So the actual effects on inflation have been quite modest so far. It's really not. It's a small amount, but I mean, for example, I mentioned that core PCE inflation is 2.9%. Maybe 0.3 or 0.4 of that is tariffs. So it's not the big factor. It's not a big inflationary thing, but it is something that is driving up inflation a bit. And the question is, are companies then, are they going to eventually be able to pass that stuff through? And then that might drive inflation up a little higher. So we've been watching this since the beginning. It's half our mandate is inflation. And I would say that the pass through to consumers has been later and less than we expected. How much of that will continue, I don't know. But the responsible thing from our standpoint was to watch and wait, because it's our job to make sure we don't make a mistake on inflation.
Well, that was my question. Do you imagine that is going to change, where the cost of tariffs will be more deeply embedded and passed on to the consumer? What do you foresee as?
So our forecast, and I think almost all the forecasts are for there to be a one-time pass-through, which will go through the end of this year, well into next year, and that by the end of next year, the one-time increase from the tariffs will be done, and you'll be back to the non-tariff related inflation, which should be much closer to our 2% goal. That's almost everyone's base case. It's actually our job to make sure that that's the outcome, though. So we can't be in a situation where we're just going to assume that. We can't leave that part of the goal unguarded. And so that's why we've been careful about cutting. We didn't want to cut too early. I mentioned in my remarks, if we cut too early, we may find out in a year that inflation actually wasn't under control and it's back up to 3.5% or 4%. No one thinks this is the base case, but that's the risk of cutting too early or too much. Of course, the risk of cutting too late, as I mentioned, is that we unnecessarily, the labor market weakens unnecessarily. There's no risk-free path, and it's a very difficult policy environment when your two goals are telling you two different things. You've got to make a compromise, and we really, again, haven't been in that situation for many, many years. It does happen, but it's happened now, and we'll manage our way through it. But we sort of have to look at both of them as equal. We can't just say we're going to do this one and not that one, unless this one is clearly a greater risk. And now they're coming into closer balance, I would say. We do see meaningful weakness in the labor market now, very low job creation. The unemployment rate's still low, though, and the quits rate is low, and a lot of things suggest that the labor market has reached a kind of unusual stability of much lower demand and much lower supply for workers. It's a really unusual kind of a balance, if you want to call it that, but nonetheless, we think it's downside risk.
Well, if you could elaborate, what are some of the factors that are leading to depressed demand for labor?
So depressed demand for labor, based on surveys and talking to people who are doing hiring, a big chunk of it is that they're just unsure about what to do. Businesses, and I'd love to talk to people after this. Businesses don't want to do a lot of hiring. They may be postponing major CapEx, major initiatives, major acquisitions, and maybe they'll replace workers who retire, but they're not looking to grow. This isn't every company and every part of every company in the world. It's just an effect kind of at the margin. That's got to be part of it. I think that's the demand side. The supply side, of course, has a lot to do with immigration policy. So immigration was at a very high level for 2 or 3 years before this year, and now immigration has really gone close to zero, and immigration is not really contributing to the labor force growth now, whereas it's been most of what the labor force growth was, and now so at the same time you've got declining demand and also declining supply of workers, of new workers.
One of your passions is demystifying the Fed. You enjoy speaking about it, and those that are Fed watchers are wondering, will there in fact be 2 additional rate cuts before the end of the year? Of course, we're uncertain about that, if I understood your comments correctly. What does it mean to demystify the Fed, and what can each of us in this room do to be better Fed watchers for the benefit of our own businesses, if you will?
So not so many years ago, maybe 40 years ago, and for a long time before that, the main theory of central banking was to be mysterious and obscure. In fact, Montague Norman, who's a very famous former head of the Bank of England, but ending in the middle of World War II, famously said, never apologize, never explain. And he thought that monetary policy worked back, and everyone thought, it works best when no one understands. It's kind of mysterious. So starting maybe 40 years ago, a bunch of economists, including Alan Blinder and a number of others, said, you know what, that's wrong, because if markets and the public understand the way you'll react to incoming data, then they'll kind of do your job for you. And so they argued for greater transparency. And people said, you know what, that makes sense. So central banks started being transparent. The Fed didn't even issue a post-Federal Open Market Committee announcement until 1994, and then did so as an experiment just to see what would happen. Now, so if you fast forward through, the 30 years since then, now we have a post-meeting statement, we have minutes, we have press conferences, every FOMC participant is on Squawk Box, we have a press release. So, and maybe some people say it's too much, it's excessive, but so that's the way it's evolved. So we try really hard to communicate with the interested public in a way that is useful and comprehensible and jargon-free. That's what we focus on. And that's all we're trying to do. So we don't use their, every profession has their jargon, and you kind of need it for internal conversations, but we try not to do that. So that's all we're trying to do. A couple of thoughts about what, I wouldn't say, I can't make anyone a better Fed watcher, I don't think, but things I would want to tell people about the Fed. One is just this, that we're making decisions, our decisions are made under elevated levels of uncertainty, even in normal times. The economy is fundamentally, no one has been able to predict the economy more than for the next few months. It's an unpredictable, it's this enormous entity and it's just not that predictable. So we have to we take very much a risk management approach, and one of the risks we're managing is that we don't exactly understand what the current state of the economy is and where it's going to go. So we try to have policy that can cover the range of plausible outcomes, not just one outcome. So that's one thing. So we're never saying that we know the economy is going to do this or we know it's going to do that, because honestly, it just, famous statement is, financial forecasters are a humble lot with much to be humble about. So that's one thing I would say. Another is that you should, I just have to say this, whenever we make decisions, we're never, ever thinking about political things. And so we're based in Washington, D.C., and many of people, in Congress, and they're often things are seen through a lens of, is it good for this party or bad for this party or this politician? We're just not looking at things that way. We're looking at what's the best thing for the people that we serve in the medium term. What's the best policy? And many people don't believe us because they think, come on, you're really political. But the truth is, mostly people who are calling us political, it's just a cheap shot. And also, we don't engage. We don't, our argument is doing our jobs. We don't get into back and forth with external people. We just do our jobs. We keep our head down and do our jobs. That's what we do. So those are two things I would offer about the Fed.
We have run out of time. We have come to the end of our program, and I'm wondering if there's anything additional that you'd like to share with the members here today, and again to help us be more prepared as we begin to look to 2026 and strategic plans for business and things on the horizon that would help to, of course, create more jobs and more prosperity.
So I'll say one more thing that struck me just now about the Fed, and that is, remember, we have a really important job: maximum employment, price stability. We regulate and supervise the banks. We operate parts of the payment system. But those things are really about cyclical demand management and financial stability. The policies that really matter for the U.S. economy in the long run, things like investment, particularly investment in people, that's not something we can do. I think we get a disproportionate amount of attention compared to the things that really matter for the country, which are the things that Congress can do and the private sector can do, which are the things that will really matter for future generations, are not interest rate policy and the things that we do as important as we are. And beyond that, I'll just say this has been great, as always. I've enjoyed talking to so many people here today, and I love to get out and talk to people who are working in the real world in the economy. There's nothing better than that. Most of my career was in the financial sector, and I constantly was out talking to people rather than sitting in my office looking at aggregate data on the economy. So this is a much more comfortable place to be.
You are headed back to D.C. later this afternoon.
Yes.
What does the rest of your day look like?
Get home. I won't get home until after dinner, so it looks like me working on the plane on the way back. So anyway, thank you so much. It's been great. Thank you.
Chair Jerome Powell, Chair of the Federal Reserve.
All right, guys, that is the Powell speech. Markets have not reacted favorably to this at all. The VIX is high. The NASDAQ broke lows. We're down to 49.9. So Powell said a couple things. Like, we summarized it. Powell essentially said this. He said the recent rate cut was a response to downside risk to employment. It was a step towards a more neutral policy stance. The current policy is not predetermined. There are two-sided risks with no risk-free option. The policy remains modestly restrictive and can respond to future economic developments. Economic growth is moderated. Downside risks to employment have risen. Inflation has increased and is still elevated, so there's risk to the upside inflation. A lot of people are talking about stagflation after this speech. That's what I think as well. Powell basically confirmed it. He said the labor market is less dynamic and somewhat softer. There's a challenging decline in both supply and demand for workers. PC inflation was likely 2.7% in August. Core PC 2.3%, driven by goods prices. Good prices increased largely reflected tariffs, not broad price pressures. The Fed's reasonable base case is that tariff-driven inflation will be short-lived. Apparently, he says lived and not short-lived. Disinflation continues for services, and long-term inflation expectations are mostly in line with 2%. The Fed will ensure that any one-time price increases from tariffs doesn't become an ongoing inflation problem. And then he also noted that public trust in institutions have been challenged. I need some water, just like Powell. And that public servants must focus on their critical missions. Yep. The chat was making me laugh. I'm sorry, but y'all were making me laugh. Just with what y'all were saying, you know. I said water is transitory, you know. But yeah, I need some water. This coffee. I don't want to drink coffee right now. I want water. Anyways, that was the Powell speech. A lot of stagflation worries afterwards. And yeah, hey, listen, just shout out to you guys. We did break 166,000 subscribers. Thanks so much. I appreciate you guys. And yeah, we had 3,000 plus people here, 3,400. You know, I appreciate you guys watching the stream here. We do it. You guys know we're going to cover it. And so subscribe if you haven't yet. NVIDIA breaking down. NASDAQ just cracked lows again here. Look at this drop. So we're down to 24,893. The VIX is elevated. Gold. Bitcoin is down on the day now. Gold is elevated, getting close to all-time highs. Gold is very close to breaking all-time highs right now. Look at the NASDAQ dip here. NASDAQ's dropping quickly. Gold around all-time highs. And yeah, Powell's speech is over. Market's breaking down here on this. Look at this drop. This looks like it's some type of other catalyst, though. Gold is very close to all-time highs. I'll buy gold. Yeah, it was pretty neutral, is what it was, right? Like, again, I said I thought he'd be pretty data dependent and neutral this morning, and that's what it was. He did say downside risk to inflation. Look at the NASDAQ flush here, guys. I'm starting to see a big breakdown. I'm trying to see if there's any breaking news that might be pushing this. But I don't really see anything. Disney raising the price of Disney Plus subscriptions. Again, if you want to help support the channel, check out Top Step. Great way to help support the channel. No PDT in futures. You can day trade the S&P, NASDAQ, Dow, Russell, Gold. Very similar to day trading stocks. Instead of losing, and every new trader loses for the most part. In general, there's always outliers, I guess. Some people just get lucky, but most new traders lose. Should you fund your own account $5,000, 10 grand, 20 grand to do it? No, probably gonna lose that. Instead, $50 a month, you're risking something. If you pass it, you get a 50K funded account. If you fail it, you lose $50. It's the best of both worlds. 90% split if you can pass the test. Once you're funded, you get 50K funded account, 90% split. There's larger packages as well. Zero commission on Top Step X, which is the platform you see on the left. It's a great way to help support the channel. Remember, guys, I'm not an investment professional, though. I'm not liable if you lose money. Always make your own assessment. Trade smart. I can't guarantee anything. Top 3 most biased person ever. But yeah, markets are dumping down here after Powell concluded his speech. If you want to check out Top Step, I'll put the link up. I'll pin it to the top, and you can help support the channel. There's the link right there. Appreciate the love. We day trade live every day. We cover every major market moving event. The big story I think this week now, guys, is PCE inflation. VIX just broke highs of the day. I might buy this gold dip. Again, the big story of this week is PCE inflation data. PCE inflation data is coming on Friday. We also have quarter 2 GDP on Thursday. Very important reports. Yeah, we got GDP data Thursday. It's going to be quarter 2, third revision, finalized GDP essentially. And they've had some labor report revisions for May and June, which was quarter 2. And then the big boy report that we get this week is PCE inflation, which is actually the Fed's preferred inflation metric. So the Fed's preferred inflation metric is PCE inflation. It drops Friday at 8:30. We will be streaming it live right here, just like we always do. It's a great way to help support the channel, you know. Is just to tune in for that. Hit the subscribe button. And then next week we got a whole bunch of stuff. But are you guys bullish or bearish on the speech? Let me know. Kind of neutral. I thought it was kind of sideways. I think either way, there's a lot of fears right now in markets. You know, it's hard to get in homes. More interest rates are still high. 25 basis point cut's not going to do much to help that, I think. You know, mixed with high inflation fears and labor market weakness showing up. yeah, I just think there's a lot of worries to potentially be had in markets from that stuff. And gold's at all-time highs, showing fears. Yields are, yields are a little bit higher, I think, over the last few days, so the last week since the last Fed meeting. So we're really kind of in this neutral scenario here, where we got a little bit of fears on both ends of the monetary policy. Both ends of the dual mandate aren't necessarily looking good, is the point. And yeah, we'll have to see what happens here. Nasdaq just cracked lows again. See what gold does for the rest of the day. I'm curious about where it heads now. Nasdaq just broke lows again. Yeah, this is a big drop. I'm trying to see if there's any catalyst that I can see here. Disney raising the price. Okay. And yeah, again, check out TopStep. Great way to help support the channel. No PDT in future. Gold's breaking down right now. Look at gold. Let's see if there's any news. I don't really see anything. I see World Bank says it will accelerate support for Argentina. Will combine public sector financing and private sector investments. See that going on. I see anything else? Let me know if you guys see any reason the market's dropping. Maybe the market comes back. Gold got really close to all-time highs and then dipped. I'm starting to bounce back a little bit here. Oh, my music's off here. I got you. Hold on. Looking at our poll number, we asked people, are you bullish or bearish on the speech? 53% said bullish. Kind of sideways there. Yeah, I'm gonna get out of here probably, guys. I'll probably get out of here. And yeah, y'all have a great day. I'm curious about buying this dip in gold, though. I might take a swing buying this dip in gold, but we'll see. We'll see. Y'all be safe. Be careful in markets right now. Tomorrow we got new home sales and some other stuff happening. Big moves in markets. So I'll see you guys then. Again, check out TopStep. You want to help support the channel. Again, subscribe if you haven't. Listen, we cover every single major economic event. Every single major economic event. We're here for it. You can hit the subscribe button. If you hit the notification bell, you will get an alert anytime we go live. And we cover every single Jerome Powell speech, every single FOMC meeting, every single major 8:30 economic report we're live for. And we get thousands of people tuning in to watch them. So subscribe, hit the notification bell. And yeah, I appreciate the love, guys. We'll see you. Let me know right now, real quick, before you guys head out. Do you guys think the market closes red or green today? Red or green? Right now, we're red. We're pretty red at this point in time. But let me know if you think the market will close red or green. I think either one of them is possible right now. Yeah, I think either one of them is possible. I think we're pretty red right now, though. I appreciate becoming a member. Diego, appreciate it, brother. Thank you, sir. Looking at the chats. Thank you. Greetings from Sweden. What's up? What's up, man? Hey, welcome. President speaking. Way overdue red. Maybe. Alright, guys. Y'all be careful. The Ukraine president says he will brief U.S. president on and that they have good news. Yeah, but y'all be careful. See you guys a little bit later. I'm gonna get out of here. Oh, yeah. I'm pretty sure I already did, but let me make sure. Scheduled the other stream. I think I gotta set redirect here, but thank you, Paul. I almost closed it down. Thank you, sir. Yeah, so I'm gonna put a schedule up on the next stream here that we got going live tomorrow, 8:30 Eastern Standard Time. We'll redirect everybody there. As soon as you get there, stick around. PC inflation is coming soon, so y'all just be careful. And I'll see you guys over there. Again, as soon as I close this stream, it's gonna bring you to tomorrow's stream. Sit and wait tight here. I'll see you guys later.